Well, how we doing football-wise today? Is your team winning? Mine didn't. I don't think. I actually didn't watch the second half because the Rams were doing so poorly. Anyway, AJ is continuing to follow up on the 4680 situation. He says, to remind you that Tesla's last 3 months average 4680 production rate vastly exceeds the cyber cell needs, leaving significant supply for semi and or Model Y use. It appears Tesla finally cracked the nut on 4680s. That's the key. The key thing here is this appears that Tesla is now going to be flat out. So ultimately, the economic strategic benefit lies not in the absolute improvement of the 4680 month over month or quarter over quarter, but in the size or the difference between Tesla's 4680's economics and the alternative solutions available to competitors in the markets from CATL, LG, Panasonic, and BYD. I'm not as crazy. I don't really care as much about that competitive advantage. What I care about is getting the cost down on all Tesla products so that just lots more people can afford them. And I know that that's very high on Elon's list as well. Moreover, the profit margins, that's the other part that's exciting, especially when you take into consideration the money from the IRA. Now, you know, have a mixed feelings, and Elon has mixed feelings about the IRA, but while it exists and while it's something that we can take advantage of, it's going to put a lot of money on the table for Tesla. AJ has a second post out just now, and he says the main consumer, China, is shifting quickly to renewables. He's talking about the overall electric market, the power market in the world. He says the population there is shrinking, and the biggest consumer of gasoline diesel cars, they're quickly shifting to electrified vehicles, with new ICE vehicle sales having dropped below 50% market share. So China's largest oil company warned last year that they see demand for gas/diesel reducing due to the influx of electrified vehicles. That's a great future. And this is going to be something that's going to have more and more impact. It's already having an impact in Northern Europe. It's going to have an impact. It's already having apparently an impact in China. It will definitely have an impact here. Teslarati says images of the FSD supervised button, which remains disabled for now, were shared by industry watchers on social media this weekend in China. As per the images that have been shared so far, China's full self-driving button is located in the same menu as the traffic-aware cruise control and auto steer, similar to vehicles in North America. Interestingly enough, it says the screenshots from the Tesla community in China indicate the FSD supervised would require updating their navigational maps in order to be enabled. The message also indicated that the updated navigational maps would require a Wi-Fi connection in order to be downloaded. The sightings of the FSD supervised button in China-based Teslas has been received with much optimism by members of the electric vehicle community in China. China, after all, is a market that is eagerly awaiting the release of the full-on Tesla FSD system. Even Tesla's rivals, such as XPeng, have noted they were looking forward to FSD's release in the country. Reports from China in previous months have suggested that Tesla's hard at work preparing for the launch of FSD in country. During Elon Musk's surprise visit to China in late April, authorities announced that Tesla, as well as other automakers like BYD, have met all the data processing requirements in China. Tesla also secured a deal with Baidu for navigation and mapping data. By June, local reports stated that Shanghai's Nanhui new town had facilitated 10 Tesla vehicles that would be carrying out an FSD pilot program. Elon Musk also noted during Tesla's second quarter earnings call that he's expecting FSD to be approved in China by next year. And then Teslarati also reporting 2 in a row for Teslarati today. Tesla seems to be setting the stage for an expansion into the Philippines automotive market. This is hinted at by several job listings on Tesla's career website for positions that are based in Manila. A look at Tesla's career website shows the electric vehicle maker is hiring for several key roles, including a leads generation program manager, a store manager, a service manager, and a delivery manager. A number of job openings related to vehicle parts and services was also posted by the company. And then there's this from who's this from? Here's Oh, I'm sorry. That was something in the middle of the article that I should have gotten rid of. All of Tesla's Philippine-based job listings on its career website today are based in 𝐄𝐦𝐚𝐢𝐥, Manila, which is the home to, Bonifacio Global City, a central business district and one of Metro Manila's most high-end areas. The district is currently home to several other automakers like Lamborghini, Maserati, Porsche, Audi, and Lexus. There you go. All right. The Philippines' electric vehicle market is still in its infancy, with the vast majority of the country sold every year still being powered by internal combustion engines, of course. The adoption of hybrids in the Philippines has only just started to pick up pace in recent years, and many are there are very few full-on battery electric vehicles. It's comprised of more affordable offerings such as the Cherry QQ ice cream sold in the country as the Jet Tour ice cream, the mid-tier EVs such as the BYD Atto 3, and luxury electric vehicles like the Porsche Taycan. A few Teslas have been sold in the Philippines, but all of them were privately imported. To succeed in the Philippines, Tesorati feels Tesla would have to work extra hard to debunk some long time and long addressed myths about electric vehicles. But if Tesla is successful, the company could establish a strong presence in one of the Southeast Asia's most robust auto markets, which sold 441,000 in 2023. All right. Is that their total automobile market? Is 441,000 or the total? Yeah, it's the total auto market. Not that big. All right. You know what this is, of course. This is the Monday morning show where we talk about what's going to be happening next week and how does it look, what kinds of exciting, fun things. Well, there's one big one on Wednesday, but let's build up to that. We'll build up to that. We'll let the tension grow as we get closer to Wednesday. So let's start with Monday. On Monday, we have the Empire State Manufacturing Survey, and the folks in the New York area have not been doing well. This Empire State Manufacturing Survey has been lousy month after month after month after month, and they're not expecting it to get better. The folks that are judging and being polled, last month it went down 4.7%, and in this case, they're expecting to be down 5%. And that is not a good sign. But anyway, we'll see what actually comes out on Monday morning. I'll be reporting that as always. Okay, then Tuesday. This is the one that a lot of people are really going to be watching because, as I've said, I don't know, at least 100 times on this channel, the consumer is running out of money. The consumer has spent all of the money from the COVID extra money that we got. They've gone through all their savings. Now they're putting money on their credit cards. Now they're getting behind on their credit cards. So when U.S. retail sales start to fall, that is going to be, another indication of where we're going. Well, the headline number for Monday last month was 1% and was up 1%. This month, they're expecting the headline number to be down 0.3%. Now, that would be, a big deal, but not huge. Although, when you take out automobiles, retail sales are actually expected to, this is not the number, this is the expected to number, go up by 2.2%. So they're expecting auto sales numbers to come in really bad for the month. Down, that would be, I guess that reflects a 0.5% decrease in auto sales. Then you get to industrial production. That number comes out on Tuesday morning as well. Last month it was overall down 0.6%. This month, they're expecting to tick up just a tad by 0.1%. We'll see if that comes true. And then we also have capacity utilization, which has been sitting at 77.8, which is not a good number. You really want it to be up much closer to 80%, even over 80%. And they're expecting that to also tick up a bit to 77.9. Business inventories, as I've mentioned 1,000 times, business inventories being up or down can be good or bad. It's not necessarily something, but when you're looking at last month being up 0.3 and this month being up another 0.4, that's probably a bad sign. I'm guessing that is automotive a lot. They don't show this with an automotive separately. I'll check when I'm looking in there to see if there's any breakdowns, but I don't think there is. Then we get home builder confidence also on Tuesday morning. Last month, that was at 39, a very, 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 very bad level. It's expected to perk up a bit to 40 because why? Because we're expecting something big to happen on Wednesday, and we're almost to Wednesday now. So what's going to happen on Wednesday? I'm sorry. I'm in a silly mood this afternoon. All right. So on Wednesday, we get in the morning before all the excitement in the afternoon, We get, or, depending on where you live, we get the housing starts. Last month, it was at 1.24. They're thinking that's going to pop up to 1.31, and building permits were at 1.40. They're expecting that to pop up all the way to 1.41. So a little bit of good news in the building permit and housing starts, if these turn out to be the numbers. Then at 2 o'clock Eastern, 11 o'clock my time, we will have the federal, decision, the Fed's decision, FOMC decision on the interest rates. Some people are expecting that to be 5 basis points. Some people 50 basis points. I'm sorry, to be half a percent. Some people are expecting to be 1/4%. And I am leaning towards 1/4%. And I would not be shocked to see it go either way from there. I wouldn't be shocked if it was 0. I wouldn't be shocked if it's 50, because the Fed could make an excuse for any one of those numbers. So it's really, really a hard call this time. So I'm sticking with my 25 because of Chair Powell being so conservative in his approach. By the way, the street is not making any guess on that. And then the press conference comes at 2:30 Eastern or 11:30 here. I will do a report immediately after the press conference. And then eventually I'll probably have a conversation with Jeff Lutz that night where we can talk it all over. Okay, then on Thursday, as usual, the initial jobless claims. Last month that was 2:30. The street is expecting that to come in exactly identical at 2:30. Then the Philadelphia Fed manufacturing survey, and the Philadelphia Fed was doing really well until last month. That they were getting really good numbers, and last month it went down 7%. This month they're expecting that to perk back up 2.7%. Then we get existing home sales on Thursday. That would be last month 3.95, which was a bad number. And they're expecting that to go to 3.88, which would be a bad number, an even worse number. And this U.S. leading economic indicators, which nobody pays any attention to anymore, which has been down like 16 of the last 18. I don't know. I can't keep track anymore. It's been down like for 2 years in a row. That is expected to drop even further. It was down 0.6% last month. They're expecting it to go down another 0.4%. Still don't quite understand why the U.S. leading economic indicators is no longer that interesting to anybody. Then on Friday, there's nothing. We can all relax, have a nice toddy or whatever it is that you drink, and not worry about anything. Maybe a hot chocolate. Okay. We've got this from Business Insider. In fact, we have 2 articles from Business Insider. Don't like Business Insider, but when all of it, almost 100% of the article is quotes, then I'm okay with Business Insider. So this one says the U.S. is moving toward a recession, according to Bank of America. Feeling the come down after trillions of unproductive cash was pumped in during the pandemic, according to former Commerce Secretary Wilbur Ross. I'm sorry, this is not Bank of America. That's next. So this is Wilbur Ross, former Trump administration official, gave a bearish outlook with Bloomberg. His forecast is contrary to what a lot of other people are saying, which we're expecting this soft landing. Well, he says, quote, I think the U.S. is headed towards probably a very mild recessionary period, and that shouldn't be too surprising. It was artificially propped up by all the great situations that have prevailed, all that cash that was being pumped in the economy in the aftermath of COVID. I think they overdid it, Ross said. Yeah, you think? The U.S. government doled out about $5 trillion in stimulus during the pandemic, which revved up the economy when stay-at-home orders shutter businesses and sent unemployment rates soaring. But most of the stimulus cash wasn't deployed productively, Ross said, pointing to Americans who immediately spent their checks in a wild shopping spree for whatever they could get their hands on, including lots and lots of cars. The burst in spending fueled demand for goods and services without increasing supply. That suggests it was the main cause of inflation, he added, with consumer price increases notching a 23-year record high in 2022. And that was without interest. That's why when Trump is out there saying this might have been the worst inflation ever, I don't agree with him on that one, actually. But it was the worst, maybe the second worst ever. And it was, and that was at 9% without interest rates being included. And that makes a big difference between the way that it was figured back in the 70s and the way it was figured this time. Strength in the labor market was also partly distorted by stimulus cash, he suggested. He estimated that about 30 to 40% of the jobs created after the pandemic were government-related jobs. What have we also been saying? They weren't building the economy. They were creating a supply of goods, Ross added. The red-hot job market has cooled down now, along with inflation over the past few years, thanks to pandemic stimulus wearing off and the Fed's rapid interest rate hikes over the past year. Yeah, see, this is that same old thing again. The economy would have taken care of all of this. Maybe a little tweaking by the Fed would have been helpful, but this was not the way to do it. Investors have been increasingly concerned the Fed may have tightened financial conditions too far. Hiring has steadily slowed over the past year, with the unemployment rate triggering one long recession indicator with a perfect track record. Well, more than one. So the SAM and the reinversion. Most economists still agree the economy remains on solid footing, given the rapid pace of growth and historical low employment rate, but still sentiment has soured slightly as investors keep their eye on the Fed's next rate move and continued signs of economic weakness. Americans grew more concerned about the labor market during August, according to the Conference Board's latest survey. Meanwhile, 40% of traders, this is a big one, 40% of traders said they feel bullish on stocks over the next 6 months. That is down from 52% last month, according to the AAII's latest investor sentiment survey. Anyway, the second article from Business Insider is about Bank of America. It's a very contrarian view and one that is the opposite of how I personally see things. But what it said was this: the market is getting more volatile. Stocks will stay choppy for years ahead, according to Bank of America. I have no idea whether stocks will remain choppy for years. The firm said that in the near term, and by the way, sometimes I really like Bank of America's analysis. The firm says that in the near term, election-related policy uncertainty will keep the market swinging. I agree with that part. Looking further out through the end of 2027, especially if the president keeps getting shot at, that's going to create some volatility, but fortunately he's fine. And so probably tomorrow won't be volatile because of that. Looking further out through the end of 2027, the yield curve is signaling more volatility ahead, as shown by the chart that they provided that I'm not providing you. Further, a proprietary Bank of America regime indicator has swung into downturn territory. With those elements at play, the firm is recommending defensive stocks that generally outperform in times of uncertainty or weakness. Quality, stability, and income have protected investors in prior volatile markets. We recalibrate our sector call to augment these characteristics, according to the analysts. On the flip side, investors should avoid boosting exposure to the popular tech sector, the bank warned. So I think that it would be perfectly fine to be defensive about through the election. and then I think after the election, it's going to be time to become more heavily invested in Tesla. Even if price swings help cheapen mega cap industry names, several qualities still make this cohort an unfavorable investment, the bank said. Don't buy the tech dip, analysts said. We remain underweight information technology despite arguments that it has gotten so beaten up. The bank cited record highs in the sector's enterprise value to sales ratio, a signal that these firms remain overvalued. Meanwhile, tech funds could soon face passive selling pressure as the S&P 500 prepares new index cap rules. That's true. Specifically, the index is planning to lower the weightings of stock funds with $350 billion in assets. Bloomberg reported, in this event, passive investment vehicles would have to restructure their holdings at the upcoming quarterly rebalance. Remember that last year? It was a big deal. As volatility picks up for the long term, quality and income should play a larger role in portfolios, according to their analysis. Although growth stocks make sense when borrowing costs were low through the 2010s, this is changing in the next years. The bank expects single-digit returns on those stocks. Quality exposures also make sense in the more immediate term, according to somebody, Savita Subramanian, B of A's head of U.S. equity and quant strategy. Don't be a hero, she told CNBC on Friday. Just park just to park in safe total return type vehicles where you get paid to wait. In a note last week, she said that today's quality stocks are not expensive, and those rated B+ or better are trading at slight premium to their low quality peers. Meanwhile, utilities and real estate dividends should attract investor attention as Federal Reserve interest rates are cut, leaving them hunting for yield opportunity. Real estate dividends are likely more substantial than during prior cycles, given that since 2008, the sector has doubled its proportion of high quality market cap to a whopping 70%. These are B+ or better stocks. All right, that's all for that. Let's go ahead and take a look at where bonds are right now. We got bonds in the pre-market up slightly, but that's after falling a lot last week. We're still on the 10-year, we're still at 3.657. That is up 0.8 of a basis point. We have got the 2-year up 0.1 of a basis point. I'm sorry, 1 basis point rather. So very, very close. So they're still about 7 basis points apart. You got the 2-month up 0.5 a basis point. So it's not doing anything too radical today in the pre-market so far. All right, let's go ahead and look at oil. Oil is, where did oil go? Oil, here it is. Okay, barely up 0.26 for the Texas Intermediate, 0.17 cents. I'm sorry, 17 cents for Brent. There's really nothing going on there right now. So you got $68.91 for Texas. You got $71.78 for Brent. These are very good. This is a very solid, nice place for the economy. If it goes lower than this, sometimes it gets more difficult. As people start shutting down oil wells, etc. So we'll see what happens over the next few weeks. Natural gas, I did do a bunch of reading about natural gas over the last few days. And natural gas, right now, there is just a lot more flexibility in natural gas than there is in oil. Is one of the reasons why there's so much volatility. And so the weather just really has way more, like, as people think about a colder than average winter, which might create a shortage, or a hotter than average winter, which would cause a glut. And so this is part of the reason why we see so much volatility right now. I'm going to keep reading on it. I'll keep giving you updates. Natural gas, though, right now is down 0.69%, which is a very small move, but sitting at $2.29, which is pretty good for natural gas recently. Gold down a teeny bit, $3.70 in the pre-market, but still way over 2,600 at 2607. Silver continuing up 0.84% at 31,335. Copper down 0.31% at 4,223. I know, really, seriously, 4.223, 4.222. I mean, it's like, okay. Anyway, if you watch the show all the time, you know what I'm talking about. It's like always that number, it seems, feels that way. The dollar dropping to a 9-month low against the yen. So the activity by the Japanese is apparently working a little bit. So the dollar is down just but 0.06%, up against the euro, again, small, well, right, whoops, it all just went away. The app just let me down again. Okay, here we go. Okay, up 0.1 against the euro. Then you got the Bitcoin down 711, 59,128, still under 60,000. So recently it's been kind of in that 54 to 60 range. Doesn't seem to be able to break, to really seriously break above 60. And then for some reason today, the online app for CNBC is not working. So I need to go over here. All right, so we got the Dow Jones. Here are the pre-market for the equities. You've got the Dow Jones is up 30. S&P is, I just changed to 26, or 0.06%. You've got the S&P basically flat, 75 cents, up at 0.01. You've got the NASDAQ down, also almost flat, $5.75. Wow, just changed to 7 as I was watching, or 0.04. By the way, I get to give you the Russell too. The Russell's up a little bit. Again, pretty flat, up 10 or 0.5. And there you go. There is where you have the equities right now. So you really can't get much of a directionality for tomorrow from any of that. But that is all I've got for you. Well, okay, so what should I say? If you haven't done it yet and you're still with me, could you hit the like button? If you haven't done that already, subscribe, of course. I can't imagine that you haven't subscribed, and hit notify. Of course, tomorrow will be a full day, all the normal stuff. Love to have you go back and take a look at either one of my 2 videos earlier today. I know it's football Sunday. I should probably only be doing 2 videos on Sundays, but I did do 3 today, and the one in the morning was all about, it was really, really good. Got a lot of views too. What was it about? I don't know. I can't keep track anymore. I think it was, never mind. I'm not even going to try to guess. I'll put the card up and the card will tell you what it was about. All right, enough. I guess I'm done. And as always, of course, it has been great. Oh, Patreon, that would be something good to do. It's been great talking to you.